Welcome, everybody. My name is Jeff Green. I will be your host for today's housing market update, October 19th, 2021. The year is flying. Let's jump right into it because we have a lot to talk about. It's a very interesting time, to say the least. So we're going to check in with our panel in just a little bit, but let's get right to the stats. An amazing amount of appreciation has taken place in the housing market in the United States of America. The July year-over-year numbers from 20 to 21 is 19.2% average appreciation. That is just a breathtaking percentage. Basically caused by lack of inventory and people wanting to move out of the metropolitan areas into the suburbs. That's really what's caused all this to happen. Couple that with low rates and a robust economy, it has just been a feeding frenzy for the last 18 months. So when you take a look around the country and you can see where the different regions are, the red means that it's been over 20% appreciation. The orange is 15 to 20% and the blue's below that. So it's really been hot all around the country. I mean, there really isn't an area that hasn't experienced very solid appreciation, just some hotter than others. However, what we're talking about now is deceleration, not declining prices, not depreciating prices, but decelerating prices, right? So Ivy Zellman from Zellman Associates says closings are set to decline roughly 10% year over year in the second half of 21. But again, it's not a depreciation, it's just a slower amount of appreciation, if you will, right? So, and again, that's what it means. Deceleration is a reduction in speed or rate, whereas depreciation is a reduction in value. So we're not talking about reducing values, just the rate in which they're appreciating. I think everybody understands that. So I'll move on from the definition of deceleration. So estimated home price performance, December to December. So, here's 21. This is what we're kind of averaging for the year as a whole. And then we get into 22, 23, 24, 25. So you can see a lot of the analysts are predicting that it is going to slow down, decelerate substantially in relatively short order. And then we're going to kind of bottom out around the historical average of about 4%. That's about where it is historically in terms of appreciation in the residential housing market. So where are projections going to be? I think that's what everybody's struggling with right now. That's the $1 million question: is where is appreciation headed? What's going to happen? And what you have here is three lines. The 2019 is a blue line, which was pre-pandemic, if you will, right? And then the pandemic hits in 2020, which is the orange line. You see a massive decrease because of the shutdowns and lockdowns, and then a major increase as people wanted to get going again. So how is this green line going to fare for the rest of the year? The important point to note is that although year over year numbers are starting to decelerate, we're still well above 2019, which was a very solid year on the record books. So, in reality, we're beating 2019. That's the point that we're at right now. So the big question is interest rates and inflation and how all of that stuff mixes together and where things are going, right? So we're going to talk a lot about interest rates today because it's definitely something we need to know more about. So here's just a look at, historically from January of 2020, not 21. So this is basically, almost 2 years at this point, right? Because we're sitting here in October. And look at what rates did, right? They just came plummeting down and they bottomed out basically at the beginning of 21. And they've been on the march, all year long. And we're going to be hearing from Jessica Imparato of Cardinal Financial in just a little bit. She's part of our panel today. And one of the comments that we had from her while we're sitting in, the green room, if you will, prior to going live here is that rates, we could see almost a percentage point uptick. That's what the mortgage people who are in the trenches are starting to hear. So, things are moving along, and there's many factors that led to this, including the Federal Reserve, basically saying, look, we're going to slow down the quantitative easing. And we're watching what's going on with inflation, and inflation is real. It's here. It's happening. I have some more information on that. So again, where are we headed? Are we headed north of 3? I think for sure we're going to stay there. And are we headed north of 4? But again, historically, it's a great rate, right? I mean, when I bought my first home, it was 6.5%, and at the time, that was a great rate. And historically, that is actually a good rate, 6.5%. But we've just been, at this level of rates for so long that, it just really has been a dream come true for those who have been buying homes to have rates so low. But what's interesting is that you have to understand how it's going to affect your purchasing power, right? So if you take a look at the monthly carry for a mortgage, let's say it's $1,633 at 2.75%. If that goes up to 4%, that same payment is only going to get you a $340,000 home versus what it would have gotten you before, which was a $400,000 home. So mortgage interest rates have a major impact on what it is that you can buy. And in an environment where prices are not coming down, they're going to continue to go up, but at a slower rate, but they're still going up. You as a buyer, the outlook isn't necessarily getting any better in the next 12 months. So I guess the point is it's actually not a bad time to buy right now. And, there's a lot of factors, like things are cooling off a little bit. Rates are still low. More inventory seems to be coming on the market. So, you're kind of in this place where it's actually a really good time to make that purchase. And then, if you're concerned about, well, if I purchase now, it seems to be the peak of the market, how does that, I don't want to buy now and my house be worth less in a few years. Well, this is a chart that basically, gives you some level of confidence based upon, a bunch of different analysts and their projections of appreciation over the next few years. And, you can see that if you had bought something in January of 2021, just using the average home price here in the United States of America, which, and then the average of all the projections that the financial analysts think that things are going to continue to appreciate, you would acquire $111,000 of equity over that course of time. So of course, that's no guarantee because it's a look into the future, but it gives you an idea of what you could possibly expect. Now, I put this slide in here because I think this is the most important thing to take away from this webinar today. And I just want to read this. Homeownership is one of the fundamental keys to accumulating wealth in America, hence why it has been integrally linked to achieving the American dream. Not only can owning a home provide a roof over your head and a secure place to live, but because mortgage payments, and this is where you have to listen, because mortgage payments generally remain fixed, while rents may rise over time, a home can also be a very effective hedge against inflation. Okay, that is very important to understand. Together, these features can give homeowners an enormous advantage over renters when it comes to accumulating wealth. Okay, that is really important to understand that, all right? Because we are no doubt in an inflationary time, and I'm going to get into that because I'm always trying to keep an eye on bigger external forces that are going on throughout the globe, right? Not just here in the United States of America, but what's going on around the world that you need to kind of keep a focus on. And right now, I'm just talking the inflation rate. Now, last month, I gave you a historic look at the US inflation rate, and we saw that we're pretty high, historically speaking. And now what I'm doing is I'm giving you a look on the last 3 years. Look at how it just absolutely took off here in 2021 and where it's headed. It doesn't look like it's coming down anytime soon. So inflation is here and it's here to stay. Food prices, evidence of inflation is really being felt in food prices, okay? The FAO Food Price Index, which measures the world food commodity prices, has surged 32.8% in the 12 months through September, coming in at a reading of 130 points, a level not seen since 2011. So food is a big deal, right? I mean, there's a lot of people that can barely afford to eat right now as it is, and now it's becoming more expensive. That's a problem. That's a massive problem. Have you heard of this company called Evergrande over there in China? Well, if you haven't, you should start paying attention to the news that's coming out on it, because some people are saying that Evergrande could be China's Lehman Brothers. All right. What was Lehman Brothers? Well, Lehman Brothers was a financial firm in Wall Street that went belly up back in the financial crisis back in 2008. In fact, Lehman was kind of the trigger for the whole crisis that then ensued and occurred. Now, it wasn't Lehman Brothers' fault that the financial crisis happened. They were one link in the chain, so to speak, but they were the catalyst that basically set everything off and created all the warning signals for everybody. So Evergrande is a property developer in China that owns 1,300 projects in more than 280 cities and is China's largest property developer by sales. And by far, it's one of the largest property developers in the world. It's a massive organization. Its business has expanded to include theme parks, electrical vehicles, financial services, mineral water, and it even owns a soccer team. And that's really where they went wrong. They went too big, too quick, and got themselves into trouble, to the point where they have 300 billion of debt on their books, and now they're struggling to pay its creditors. And things are really getting out of control. If you actually just do a Google search on Evergrande, you'll see some videos on YouTube of people who had been buying homes through their development and, wing of their business, and now they can't deliver on those homes, and these people are losing their money. And so they're like going in and they're freaking out, they're yelling and screaming. It's getting ugly over there. But the bottom line is they could declare bankruptcy if the interest payments aren't met within 30 days of the due date. So this is a real problem. It's going to be interesting to see what happens over there in China. And China has some real issues going on. We're going to see them pop up in another right here on this slide here about supply chain. This was a headline from CNBC. Supply chain chaos is already hitting global growth, and it's about to get worse. I've been seeing a lot about supply chain issues, worker shortages, most notably truckers. What's going on? I listened to a great piece about what's happening with the supply chain, specifically in California. You're hearing about all of these container ships sitting on the shores. They can't get in. They can't get their containers offloaded. And one of the big problems is that California passed some stringent laws a bunch of years ago. I don't know how many years ago, but it basically eliminated the ability of many truckers to register their trucks in the state of California because it didn't meet emission standards. And the emission standards in like one particular case, like if you owned a truck that was built prior to 2010 or had an engine built prior to 2010, you cannot register in the state of California. So there's all of these trucks basically not able to get registered, and they can't get into the ports to pull the containers out. That's what's really going on. And yes, there is a supply of truckers as well, but that's just an interesting fact about what's going down in California. Lack of key components and raw materials. We've been hearing about this here at the Housing Market Update for some time as it relates to lumber, right? There was a crisis in lumber for the last 18 months due to the pandemic supply chain issues. And it's interesting because that was almost like a leading indicator of supply chain as a whole around the globe, right? As over the last 30, 40 years, basically what's happened is all of these companies have enabled just-in-time manufacturing, right? So they don't keep huge stockpiles of things because it's cost prohibitive to do so. So when you have this just-in-time manufacturing, it requires every piece of the chain to be in good functioning order. And when something breaks down, it really impacts things. So power shortages in China have affected production in recent months. Border controls, mobility restrictions. And the bottom line is less inventory on the shelves of stores and higher prices for consumers. So we got to watch these things because it unfolds into people's lives, and it ultimately will impact the housing market. Another thing that you have to take a look at is oil, what's going on with oil. It's interesting that during the pandemic, the problem with oil was there was so much of it, they didn't know what to do with it. They had ships, they were filling up every possible container ship around planet Earth and just putting them out there at sea just to let them sit there because they didn't want to shut down their wells. That's where we were 18 months ago. And now there's not enough, and we can't get production back online because what's happening is people are coming out of their lockdowns and out of their funk with the pandemic, and they're starting to live life again and go at it. And now we can't meet the demand. And the new administration has put restrictions on our own oil industry here in the United States of America. So it has reduced our oil output by almost 2 million barrels, excuse me. So we're not able to meet the demand like we were. So it's a problem. So what you're seeing is you have a barrel of oil at its highest price in 7 years. And it doesn't look like it's coming down anytime soon. So that's interesting, right? It's going to affect us at the gas pump. What does that mean? Well, it just means less money that we can spend on other things, i.e. mortgages. So it will affect the housing market. There's no question about it. So let's take a look at some stats and then we'll get to our panel. Existing home sales on a national basis, you can see here that it's coming down off of last year's numbers, right? But that's okay because it was such an insane marketplace through the pandemic. In fact, I'm impressed by the fact how the numbers have been able to hold together so well, so long. I thought that activity would slow down a little bit quicker than it is. So that's a good thing. It's always nice when things come softly off a high than a tragic precipitous decline. And then here's the home sale price appreciation. You can see, right? You can see that prices were still really high, just going, but now you can see the variance here, right? This is what we're talking about, a deceleration. We're not talking about depreciation. It's just appreciating at a lower rate. All right. And then month's supply of inventory, it's creeping up, getting a little bit better, but not really where it needs to be. You know, a normal marketplace is somewhere around, 4 to 6 months. We're still down here at 2. So there's still not enough inventory to meet the demand, but it's going to get back in line as time goes on. All right, so some housekeeping things. We're going to be here again, Housing Market Update next month, Tuesday, November 16th at noon. Like we always do, you can stay in touch with us at HM Update. And a special thanks to our sponsor, NewOp, the Business Opportunity Exchange. Folks, if you're a real estate agent or a mortgage banker and you're not yet a member of NewOp, you're missing out. There is all sorts of opportunities taking place every day. You should go check it out, newop.com. All right, let's get to our panel. Here's a look at them real quick, but let's end my screen share here and get right into it with them. Okay, so welcome, ladies. We have Keren and Tiffany. You can unmute your mic there in the conference room of Green Team New York Realty, and we have Jessica Imparato. So Tiffany and Keren, we'll start with you two. Some good news, some bad news. I don't know if I scared everybody there with those last sets of slides. Do you have any just reactions before I have specific questions for you?
Wow. I think we keep waiting for it to calm down to go on vacation, and it's still not happening.
Yeah.
I don't think any of us know when it's going to end, but we're going to ride the wave.
Right. So what you're saying to me from a boots on the ground perspective is that you're still as busy as you've ever been, and there still has been no reprieve for you.
Correct.
Agent. Okay. So all this talk about slowdown, price appreciation, it's all noise to you because you, from a day-to-day basis, you're still go right now.
I think that the window shopper clients have disappeared, and now the most serious buyers are who we're out with every day.
Okay.
Who've lost houses before now and are aware of what they need to do to make it happen now.
Keren, do you agree with that?
I do. I think the buyer profile has changed a bit as far as what people want. They just want any type of a house, and they're willing to give certain things up that they wanted to have previously. They just want a house before the interest rates go up.
Right. Well, that's a good thing. I see that as a positive thing because it means that they get what's going on in terms of inflation, and that basically your wealth is eroded. I mean, the best way to look at it is, let's say you have $100,000 of cash sitting in a bank account that's earning less than 1% interest, yet inflation is going at 6%, 7% as time goes on. you're losing 5% every month on your money, right? Because your rate of interest that you're getting on your cash is not able to keep up with inflation. So you're literally losing money with it just sitting in the bank. So it's important. You got to put your money to work, right? And one of the best ways to do it is with your own home if you do not yet own one. So that's good to hear. What about appraisals? Are we experiencing any problems with appraisals? Either of you two, have you experienced any issues?
Not me. I haven't had any issues.
Karen?
I had one issue a couple of months ago and none since or prior to. So the appraisers are definitely working with us to make sure that things are happening the way that they're supposed to.
Okay, that's good to know. Do you see more new construction coming online?
No.
No.
Yeah, it's a hard thing here in our area, in the New York metro area, because the zoning laws are so stringent at this point, and the planning boards are so difficult to get through that it's just really hard for any new construction to come online. You're certainly seeing a lot more new construction around the country, but not necessarily where we operate. So I think, you talk to different people around the country, it's different in different areas. But it's just hard in the Northeast here to get new construction online. It just is, for a multitude of reasons. All right, so let's flip over and talk about mortgages. Jessica, how you doing? Welcome.
Good, how are you?
I'm doing great. Thanks for joining us today. So let's elaborate on your comment. You had been talking with colleagues about, are we going to see a point increase in a year? So let's talk a little bit more about that. What are you talking about there? And
So basically we were talking about 2022 and we can see that the MBA is forecasting some different numbers for next year, and basically whatever interest rate we're selling right now, we should expect it to be about 1% higher in a year. So we've definitely seen an uptick in rates just over the last couple of days. Yesterday we lost a quarter point. Friday they had come back down a little bit. Thursday they had gone back up. So, what I have to say about interest rates is, if you're happy with the payment that your lender is quoting you, don't be greedy, because tomorrow that payment could be gone and it could go up. And if the rates go up too much, it could disqualify you from the pre-approval that you've had for the last couple of months, if it pushes that monthly payment up too far, like you were showing in that slide.
Yeah.
So, if you were pre-approved in June and the rates were much lower, I would recommend reaching out to the lenders and making sure that your pre-approvals are still good based on what the rates are today.
Yeah, no doubt. I would agree with that. I think, penny wise and pound foolish, right? You can try to save a little bit on an interest rate, and you can end up getting yourself into this environment, which I think that we're in, where rates are just going to continue to go up, until who knows what time. I mean, there's so much inflation pressure that there has to be an increase in rates. There just has to be.
I mean, those super low rates that we had were definitely a gift. That was never going to be normal.
Yep. I feel lucky because I actually refied at a very good time, right before things kind of took off a little bit over a year ago. So anyhow, all right. Well, I guess that's it. Unless anybody has anything else to say, I feel like we've given everybody a good housing market update. We're 24 minutes in, which is 6 minutes ahead of budget. I like to keep these no longer than 30 minutes max. So unless anybody has anything else, I don't see anybody screaming or yelling at me here. I'm going to go ahead and just leave off where I always like to leave off, which is the contact information, because these are truly super individuals. Tiffany Megna from Green Team New York Realty. You see down here, here's her cell phone number, 845-674-2625. Keren Gonen from Green Team New Jersey Realty, 551-262-4062. And Jessica Imparato of Cardinal Financials. You can get a hold of her at 973-714-9063. So ladies, thanks so much for being here. I appreciate it. come again, and we'll see everybody next month for next month's housing market update. Thanks for joining us.